All righty, it looks like we have a good portion of our registrants in the webinar so far. Thank you again for joining us. I'm Katie Cook, the marketing analyst for LGT. For those of you who are joining our webinar for the first time, just a little bit about LGT. Lane Gorman Trubit is a full-service accounting firm located in Uptown Dallas. We serve our clients with tax needs, audit, accounting and consulting, business advisory, and financial advisory. So we really are a one-stop shop. I am super excited to introduce today's speakers today. We have part 7 of our webinar series. So we have 2 more parts this year, one in October and one in November, and both registrations links are available on our website. So we look forward to seeing you at the next webinar as well. We are going to hop right into it because Kat and Yolanda have a lot to cover today. A quick little introduction. Kat has joined the firm with 7.5 years of tax experience, and Yolanda has joined with a little bit over than 10 years of experience. So these ladies are going to provide you with excellent content, and you are going to be in great hands. I'm going to go ahead and pass it on to you.
Hello, welcome to our webinar. Super excited to have you.
Thank you, Katie, for that really generous introduction. So everyone on the call, I'm sure you're really excited to hear about applying tax legislation to your business. Next slide, please. So our agenda today, we're going to cover the new tax law. So the Inflation Reduction Act that was passed, we're going to get into that, the different credits and things that you can benefit from. Yolanda is going to cover some current provisions that were made permanent and some sunsetting provisions that are going away. So this will be essential to year-end planning to see what's new, what's changing. A really exciting section is how to get free money. Yolanda is going to go over, there is still some credits on the table in regards to the PPP loans and the ERC credits. So definitely stay tuned for that. And we're going to wrap up with how all of these different items affect your business and what you can do going forward. All right, so first let's get into the Inflation Regulatory Act. This was signed into law on August 16th, so very recently, and this date is good to know because a lot of the provisions are active based on the date of enactment. So keep this August 16th date in your head as we go forward. So the Inflation Regulatory Act is broken out into 3 sections. The revenue raising provisions, those are not so fun. Those are the additional taxes. The second section, tax credits and deductions. This is the meatiest part of the bill, and this is the largest section we're going to cover. And we're really just going to go over the provisions relevant to the callers, to the audience on this call. And then lastly, we're going to talk about IRS appropriations, which have been a long time coming, much needed. So really exciting to get into that. So for the tax revenue provisions, there's really not a lot to cover here. As you can see, just a small list of items. I've bolded the excise tax on corporate stock buybacks because that's probably going to affect the most people on this call. Something to know about the corporate alt-min tax, this really only applies to corporations who have a net income, a book income of $1 billion. So it really only affects about 150 companies, probably not anyone on this call, nothing to worry about there. The other items are specific to industries, as you can see. So really, let's just get into the corporate stock excise tax. So what y'all need to know for this information, this slide has a bit of information I'm not going to get into, but it's for your understanding. It really applies to corporations that are traded on a stock exchange, like the New York Stock Exchange. It's not meant to affect tax-free reorganization. So if your corporation is going through something like that, this won't affect you. It's really, what it's really meant to do is provide parity to the corporations that pay out dividends and are taxed on those dividends. When corporations buy back stock, that will increase the value of stock for its shareholders. So Congress is attempting to tax the increase in value of stock, similar to when dividends are paid out. That's the purpose of this new excise tax. And it's going to be effective starting in 2023. Next slide, please. All right, let's get to the fun part, the tax credits and deductions. This is a good list of some of these items. Just by reading this list, you guys can probably tell that these really are targeted for specific industries, a lot of it being coal, oil, petroleum, and energy. So we're really just going to get into the things that are going to affect individuals and businesses. And I've bolded some of the items down here we're going to get into. And if you go to the next slide, please, you'll see the list continues, but I'm going to just discuss the bolded items, which are going to affect most of the people on this call. So let's get into it. Okay, the first credit we're going to talk about is the energy efficient home improvement credit, formerly known as this. Just note, I have provided the code sections, not just for the Internal Revenue Code, but for the Inflation Reduction Act as well. So you guys can look at the source code and read the law. It's pretty basic. It's nothing too technical. So if you're curious about more details of any of these provisions, go ahead and look at the source law. It's pretty easy to read. Let's get into it though. So what we all used to know was we had a credit that was up to 10% of qualified expenditures subject to this $500 lifetime limit, which really wasn't that useful, but you'll take what you can get, right? The new law increases the qualified expenditures to 30%, and now is a $1,200 annual credit. So this will be really important for planning as you're looking to see what you're improving and when you do these improvements. As you can see, different categories of items are subject to their own individual limitations. So not to get into it too much, this credit can be pretty confusing because there's so many elements to it. So just wanted to show you guys some of the different items covered and what their max credit for each item is. So you could improve your windows and doors up to $1,200, but notice that each one is going to be limited to their own limitations. Something new to note is that home energy audits now are covered under those expenditures. So if you want to do a home energy audit to make sure whatever improvements you have do qualify, that will also go into the calculation of the credit. So not a bad thing to look into.
Really fast, there is a question in the Q&A from Mary Valerie. She asked if the metal roofs still qualify for an energy efficient credit.
They do not, unfortunately. Okay. That's been, that was specifically stated as not qualifying anymore. Please note, although there's a $1,200 annual credit limit, some items actually qualify for a $2,000 annual credit limit. So that the credit itself could be up to two grand, but only for specific items. So if you do, say, windows, and then you do a biomass stove, depending on those limitations, your actual credit could be up to $2,000 for any year. Again, it gets a little confusing here. So when the IRS issues the new form that you claim the credit on, it'd be a great idea to look at that form and see exactly how the credit would calculate based on your expenditures. The good thing to note about this credit is it's not refundable and doesn't carry forward. So it would be pretty a good idea to look at what you're trying to improve and upgrade and see if you can spread those out over the years to maximize the benefit you're going to get for each year. And this will be effective starting in 2023. So this will give you some time to be looking at what you want to improve and map out kind of the years you want to take make these improvements and take this credit.
And non-refundable, just to remind everybody what it is.
It's non-refundable, so it's only up to your tax liability, so you're not going to get extra money back. So this will be a consideration. Look at your income for the year, look at what you want to improve, and take that into consideration. Next slide, please. All right, similar credit, but works a little bit differently is the residential clean energy credit. So we have what the pre-law was, but let's focus on what the law is now. I have listed out the different kinds of property that qualify for this credit. So Things like solar panels are pretty common under this credit. And this does not have an annual dollar limitation. It's limited to, if you look at this chart on the slide, what the percentage is each year. So really got to look to those years, what you're improving, how much you can take. For the next, 10 years, starting next year, it'll be 30%. There's a slight change. So the qualified property under this credit, the biomass stoves will no longer apply. But if you did notice in the previous slide, they will fall under the energy efficient property credit for that $1,200 limit. So you don't lose the benefit of these properties. It's just going to fall under a different code section. The battery storage technology, they will be qualified property starting in 2023. So this one is a little different. The credit is non-refundable, so it only covers up to your tax liability, but it does carry forward, and there are no limitations on this carry forward. So keep that in mind, that even if you're not getting the benefit of the credit this year, you will have it for future years. And this is actually effective starting next year in 2022. Next slide, please. Okay, I wanted to touch on this. This is relatively, this is new, and there's not a lot of guidance out there for this, but just so you're aware, there's a high efficiency electric home rebate program. It is targeted for low income taxpayers, so may not affect a lot of you, but just so you're aware, these are the rebate amounts. This is the income limitation. So there's pretty stringent requirements for the income, whatever income qualifies for your area. There is a link down here that you might find useful to look to see what areas qualify. Don't click on it now, but yeah. This would be useful to look up to see if your area can qualify and what max credit you can get based on your facts and based on the area you live. This one's a little different because the IRS will not be issuing these rebates on your federal tax return. These rebates will be handled by state energy commissions. And so the IRS is still working to, how are they going to administer this rebate program is still in the works. The states don't have the money yet, so there's no real mechanism to capture this rebate. So it's going to be effective starting in 2023. So I think it's going to give everyone a year to get their act together, to put the procedures in place, the money in place for people to claim this. But just know it's out there and it's coming. Next slide, please. Okay, this slide I wanted to touch on, the new energy efficient home credit. The title may be a little misleading. This is not for home buyers, but for home builders. So qualified contractors. There was a credit available under the old law. The new law expands the categories of credits you can claim for each house from 500 to 1,000, all the way up to 5,000. These apply for homes that were acquired by a buyer before January 2033. So you've got some time to dip into this credit. However, a word of caution when claiming this credit is the requirements are, there's two major requirements: energy savings. So there's detailed rules on what types of energy improvements in each home, whether it's a single residence or multi-residence, that would qualify for the credit, which I'm sure home builders were familiar with before. But now there's a prevailing wage requirement. And what this does is, if you've got contractors, laborers working on a home, they have to be paid a wage that's comparable to the area in which the home is built. So if you're in a high income area where wages for contract labor are a little bit higher, you've got to adjust your labor costs to match those prevailing wage requirements, basically. There is a link. I think I've provided a link at the end of this to give more detail on how you can determine what that wage requirement will be. This will be effective starting after or starting in 2023. All right, clean vehicle credit. So I know there's a huge shift in the auto industry with now people buying electric cars, hybrid cars. It's the new thing. I think Yolanda had mentioned to me that California maybe
You have to get a electric vehicle by, I don't even know what the year is. I mean, I know it's pretty much coming up in the future. They're expecting everybody to have electric vehicles, but I think they're not even allowed to sell gas
Okay,
vehicles.
so-
So this is a huge switch for people in California and other states that align with California.
Awesome. So
Yeah.
got a huge shift. Everyone's buying electric vehicles, super fun.
Mm.
The old credit was $7,500, but the real limitation there was manufacturer limits on the numbers of vehicles. So like say Tesla or GMC, they had a limit on the number of cars that could get the credit. And those were, I'm sure, I mean, I think a lot of credits aren't available now. They've
Yeah.
all been claimed.
Yeah.
So new law, I've put requirements here. Really, this is more focused on the dealers and the sellers of the vehicles. There are assembly requirements, manufacturer requirements, and MSRP limitations. So let me just get into that real quick. The assembly requirements basically are saying that the sourcing of the materials as well as the final putting the car together has to happen in certain countries and North America mainly. So, but that's really for the manufacturers and the sellers. As the consumer, you're going to basically know how much the car credit will be when you purchase the car. It's going to be predetermined after when the car is on the selling floor. It's already determined how much credit applies to each car. So these are just things for sellers and dealers to be aware about, that if a certain car doesn't meet a requirement, this is why. I want to touch on the MSRP limitation. This is going to be good for consumers. You won't be able to claim a credit on a car unless it's, let's see, if it's SUVs and trucks, the car has to be priced below $80,000. For all other vehicles, SUVs, things like that, the price limitation is 55 grand. So that's good news that you're not going to be, completely price gouged on these vehicles because there's a credit available. These additional requirements, the critical mineral and battery component requirement, really that's what determines, that's 50% of the credits there, and then 50% is from the battery component. Those have to do with the component and assembly requirements. They have to occur within a North American country or with countries we have specific trade agreements. So that's what those requirements mean. Of course, this is obviously meant to bring manufacturing back into the United States, back into North America. The income thresholds, I put MAGI here, modified adjusted gross income, but really you can just think of that as your AGI. For married filing jointly and surviving spouses, this is 300,000. Head of household, it's 225,000, and for all other taxpayers, it's 150,000. There is no phase out. It's just a black and white. If you made 301,000, you're out of luck. So that's how those limitations work. This is effective for cars purchased starting in 2023, and it extends through 2032. I just want to touch on this transfer of credit. This wasn't available before, but the transfer of credit has been made available. And what this does is, if you don't want to wait to file your tax return and claim that $7,500 credit, you can get a transfer of the credit at the time of purchase. And basically what that will do is reduce the purchase price on the vehicle at the time of sale by the amount of the credit. Good news is it's not includable in income. And then the dealer does not get a deduction for this transfer credit. However, please note, if you do this transfer of credit at the time of purchase, and then you file your tax return, and it turns out your adjusted gross income is in excess of the threshold, then you're going to have to recapture that entire credit as income on the return. So do take that into consideration. If you're buying a new vehicle and you want to take the credit at the time of purchase, you're not sure about your income, do think about that you may have to recapture that amount. It's not just freebie money. Something else to note for the dealers and dealerships and car sellers, the IRS is working with dealerships to offer advanced prepayments of the credit, because it's not meant to be an out-of-pocket expense for the dealerships. They're not meant to foot the bill on this credit. So the IRS will be providing the funds for this credit for qualified vehicles. Next slide, please. Okay, so this slide is really available to anyone purchasing a car around this time, what rules apply. So as y'all can read here, but if you've already entered an agreement to purchase a car, but you take it into possession after the enactment of this date, then I can't see what that says. Is that new or old law? Old law applies subject to manufacturing caps. That basically means that you probably won't get the credit since all those manufacturing caps have been met. If it's purchased between the date of enactment and the end of the year, you've got to make sure the vehicle meets final assembly requirements in order to qualify for the credit under the new law. If it does not meet those assembly requirements, then the old law applies. So do be careful about that. That might not be under your control, but good news, I have a link available for you guys to see which vehicles may meet the final assembly requirements. So if you're looking to purchase a car now and you're just not sure with these new rules, take a look at this list. But I also want to insert a word of caution here that they may meet final assembly requirements. If they're on this list, that something happens, a part was sourced from somewhere else, it didn't meet the criteria, then you may not get the full credit, if any. So just do be aware that if you see a car on this list, doesn't meet the requirements, the credit may not be available. So just something to note. Okay, now we're talking about used vehicles. So it's been a few years now that we have electronic and hybrid vehicles that are used. So Congress came in and said, let's give a credit for those cars. Here's the requirements for those cars. The credit will be the maximum of $4,000, or sorry, the minimum of up to $4,000 or 30,000 or 30% of the vehicle's sales price. So I did the math on that. If you purchase a used vehicle or used clean vehicle for $13,333, then you'll get the full credit. Additional requirements are it has to be a previously owned clean vehicle, a qualified sale. So qualified sale means you can't sell the car for more than $25,000. So be aware of that when you're buying a used vehicle. And then a qualified buyer, it has to be someone who had the original use of the car, and it can't be you. You can't be selling your car to yourself as a used car and claim the credit. So it has to be two separate parties. And then previously owned clean vehicle, I'm gonna get back to that, has to be at least 2 years old. So just know you can't be just going to any used car lot, picking up an electric vehicle and expecting a credit. It's gonna have to be a qualified sale, qualified buyer. They're gonna have to have documentation to prove that this is a 2-year-old car that hasn't had that no one's claimed a previously owned credit for it. So just keep those things in mind if you're looking at used electric vehicles. The income thresholds for this credit are just basically half of what it would be for a new car. So married filing jointly and surviving spouse is $150,000. If you make more than that, you're phased out of the credit completely. Head of household is $112,500, and then for all other taxpayers, that limit is $75,000. This credit will be available for vehicles acquired starting in 2023, and it's going to 2032. This also the transfer of credit scenario I just discussed is also available for used car purchases. So keep that in mind, again, with the income limitations, that if you claim the credit at the time of purchase, you may have to recapture that credit back, and it is non-deductible for the sellers of these vehicles. Next slide, please. Okay. Just wanted to touch on this. I'm not sure how many people it affects, but this is if you have a commercial fleet of vehicles, if they're qualified clean vehicles, you can get a credit for them. And this is pretty interesting. The max credit, $7,500 for, cars under 14,000 pounds, kind of basically the same as the new vehicle credit, but you get up to a $40,000 credit for vehicles in excess of 14,000 pounds. But I do imagine that vehicles in excess of 14,000 pounds are going to be expensive. So nice little credit there. Very similar to the credit for the new clean vehicles. So just be aware that's out there. If you want more information, I'm definitely happy to give you guys that. And this will be effective starting in 2023 and it's going to 2032. Okay. So with the new electric vehicles, you have these vehicle refueling properties. So, you know, you got to charge up your Tesla now, right? You can't just go to a gas station. I don't know if anyone's seen those videos of people in Teslas pulling up to gas stations, not realizing. So you got to build yourself or use a electric charging station, right? So there's a credit available. It was available before. I do have to tell you guys, I haven't seen many people claim it. And I can see why. Under the new rules, you can actually get up to $100,000 in credit for this if you're a business. And then it's still $1,000 for personal property. It applies to 2- and 3-wheeled vehicles. So if you have like a nice electric scooter or motorcycle or something, you can get a credit for that. However, I noticed something in this law that really wasn't discussed in the online article, so I want to draw your attention to it. This alternate vehicle refueling property has to be placed in service within a low income or rural census tract. What's a low income or rural census tract? I have included a link at the end of this presentation for you guys to easily look up and determine what a low income or rural census tract is for the area you're in. So if you are planning to install a charging station for your Tesla or your Nissan Leaf, make sure you're in the right area to claim this credit. Don't build this stuff just for the credit and then it's like, oh, I'm out the $1,000. You know, just be aware. I've seen a lot of people claim this. It may not be available to a lot of people because of this requirement. It is non-refundable, so it's just up to your tax liability, and it will be effective for property placed in service starting in 2023. Okay, so we've covered basically some of the applicable fund tax credits you guys can get. A lot of it is really related to energy efficiency. That's kind of the theme of this bill, right? Yep. Let's talk about IRS appropriations. I know as a practitioner, I'm really sick and tired of calling the IRS, getting stuck on hold and being hung up on. I can imagine what it's like for non-tax practitioners because we get priority. We're not even a priority now. So I'm really excited for IRS appropriations. Here's the breakdown, just so we guys know what's coming. There's $3 billion appropriated for taxpayer services. Yay, that's the stuff we want. We want them to answer the phone, right? So $3 billion there. $45 billion is allocated towards enforcement. So if you're worried about that audit, you know, probably be a little worried. They've got money for enforcement coming. So look at those items and just be aware. There's $25 billion for the operational expenses. I'm sure it's much needed. And then I'm really excited about this $4.8 billion to modernize and upgrade the in-house technologies. I think this has been a long time coming. So really, this money is meant to be spent over a 10-year period that the IRS commissioner has discretion on how to use this money. So this isn't going to happen overnight. You know, you're not going to get your phone call answered tomorrow, but do be expecting better service, faster service. Hopefully those returns are processed more. If you're worried about your refund, it's coming. And also be aware that enforcement will be up as well. So really, documentation is going to be really important. Anything that we think the IRS has been letting slide just due to lack of resources, lack of funding, lack of people is not going to be the case anymore. So just kind of keep that in mind as we enact all this new law and apply it correctly. Be aware of that.
All right, cool. Now we're going to get into what is our tax law now, what is in service, and what is going to be going away. So the TCJA Act in 2018 brought about a lot of major changes. We haven't seen that many tax changes in just a while. Some of the more permanent items that came from this act is basically the flat 21% federal income tax rate on C Corps. I mean, this was great. They had a graduated tax rate, so going down to 21% made us a little bit more competitive with other countries whose corporate rates are lower. So it was great. It was bringing more business to the United States, which is what the goal was. Elimination of the corporate alternative minimum tax, AMT, that was huge, huge plus. Now, Kat just said it did come back.
But it's not going to affect you guys. It's literally going to affect the Apples and Googles
Absolutely.
of this world. 150 companies, not anyone.
I mean, unless the CEO is watching of Apple. I mean, hey.
Hi, Tim.
You need a
So probably won't
you should
affect you
know about
guys. So yeah.
Absolutely. So we have also more generous rules for the first year Section 179 depreciation write-offs. So this got bumped up to $1 million you're able to deduct for Section 179. If people don't know what Section 179 is, you can basically write off your equipment purchases. There are limitations on income revenue. There are also, you have to have income to get this. If you don't have income, well, you can carry it forward. You're not going to lose it. But this is something that we're going to talk about a little bit later. This is a good tax planning thing because we have some other depreciation changes that are going to come into effect. So if you lose those other ones, you might want to look into Section 179. Okay, so we also got, for small businesses, the ability to go to cash method accounting and simplified inventory. This is huge. I mean, we had a lot of small businesses that were filing accrual and they were having to capitalize their inventory. And it was just, kind of a pain. So we are now able to do the cash method. I mean, there's a form you have to file to make that election, but you can actually save a lot of money making this election. So if you are in that bucket, I highly recommend talking to your accountant about, by the end of this year, maybe making some changes and trying to save some taxes. Okay, so elimination of favorable treatment under 1031 for personal property. Personal property are like cars, computers. You used to be able to, when you sold one, you can and bought a new one, you can kind of roll that old gain that you would get into your new property. You can't do that anymore unless it's real property. So houses, buildings, you can still have a 1031, but for cars, if you trade your car in, that trade-in value is now going to be as if you sold it. You're going to have to report a gain on your tax return for that. So just keep that in mind when you're trading in cars. You need to give your documentation on that car sale to your CPA because they're going to need it to calculate that gain or loss. Maybe you had a loss. You might. All right, so we also had elimination of business entertainment. So sorry to tell you, but you can no longer go to the Cowboys game in a box seat and deduct that on your taxes or take your client out hunting. But good news, if you do go to the Cowboys game, keep your meals tickets, try to keep all the food, because if you're buying food, we can deduct those because for 2021 and 2022, business meals are 100% deductible. So that's great. So think about that. You only have a few more months in 2022 to, go out to restaurants and get that 100% deductibility, because next year, 1/1/23, you're back down to 50% deductibility. So right now, tax paying time. Maybe
So
you
you've
want
got basically until the end of this year to take me and Yolanda out to lunch.
for sure
And talk about
we're
this
totally
stuff.
down. We can give you some great entertainment, tax
Deduction for
strategy,
you.
100% deduction.
Win-win for all of us.
Win-win. So just, just saying. We also have stricter rules on net operating losses. So this is a big one. I mean, businesses used to be able to deduct all their losses. You can basically wipe out your income like a Trump, right? He had a bunch of losses, hadn't paid taxes in years. A lot of business owners do that, smart business. Well, Congress was like, no. You can only now wipe out about 80% of your taxable income. So a lot of business owners weren't expecting this. They just assumed I have this net operating loss because I did this cost seg, I'm accelerating depreciation, I'm good. Like all this money I was putting aside, pay my tax, well, I'm gonna go on vacation. Talk to your accountant before you do that.
Good news, we do have ways to avoid getting trapped in the 80% NOL limitation. So there are other ways. If you've got excess business expenses, you're going to have a loss for the year. And we're going to get into that later. I'm very excited for that.
For sure. Yeah. So it's not the end of the world, but do expect you might have to pay taxes if you have an NOL, because 20% of your income, it's potential that, you can't write it all off. There's also a new 3-year holding period for long-term capital gains treatment for partnership carried interest. That's kind of specific. If you have questions, ask your accountant about it.
Yeah. And if you have a carried interest.
Exactly. So I wanted to talk about excess business loss limitations. So this is going to affect some people. Okay, not everybody, but some people. This was created in 2018, the TCJA Act. It was suspended during COVID. And in 2021, this is the first year we saw it come back and come into play and saw our clients get affected by this. It was originally expiration date, I can't even talk. In 2025, it got extended recently into 2028. So basically, this is for businesses who have a lot of losses and they are active. Okay, so there are a lot of loss limitations. You have to have basis to take a loss. You have to have at-risk basis to take a loss. You have to have passive law. You have to be an active person. You can't have passive losses. And then after that, if you are basically, you have the basis to take the loss, you have skin in the game, you're at risk. If something happens to that company and it goes down, you go down, that's at risk. And you're not passive because you're active, you run this business, you manage it. Okay, that's where this comes in. You've gone check, 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 I'm good on all these. Next, this is where it's at. So when this first came out, it was $250,000 for single, $500,000 for married. It's adjusted for inflation. 2021 is $262,000 single, $524,000 married. Basically, if you're above those limits, you don't get those losses, you don't lose them. They get carried forward to the next year indefinitely. Actually, they get carried forward indefinitely, but they are subject to the new NOL rules, where say you can only you can't wipe out more than 80% of your income. So the next slide is kind of like a quick little calculation. So Katie, you have a business. You have 500,000 of gross income and 800,000 of deductions. So basically, you have a net loss of 300,000. Well, Katie's single. She's only allowed to take 262,000. So $38,000 of her losses are going to be carried forward. She can't take it. So she might owe taxes on her tax return due to that limitation. So just, keep a heads up. This is out there. This potentially, affect you as a business owner. Talk to your accountants because they're definitely going to know if you're subject to this.
But I do want to highlight the silver lining here is that they have decided to index it for inflation. So rather than just having the 250, 500 limit, it's going to go up every year. So
exactly. Okay, next slide. Okay, here's the big thing. Bonus depreciation. Everybody loves bonus depreciation. It is amazing. Currently, for the past few years, we've been able to deduct 100% of our tangible property, qualified improvements, 15-year property, equipment, furniture, write it off. I mean, it's beautiful. You only have a few more months to do that. So 2023, it's dropping by 20%. Now only 80% is going to be able to be depreciated all up front. The rest, you don't use it, you just have to take it over the life of the property. So it's 5 years and you'll have 5 years to depreciate the rest of it. But this goes away in 2027. Now, bonus laws keep changing. They've changed numerous times because it's a big favorite of a lot of people. We can't say what the future is what's going to happen, but there's a good chance that this might come back. But if not, you have Section 179. There are some things about each one that's good, but this is, another thing that you really need to talk to your accountant about and see what is more beneficial for you and your company and your situation. Okay, so qualified business income deduction. So corporations got that 21%. So, in order to be a little fair, Congress decided to give the other business holders, pass-through business holders, partnerships, S corps, give them something to look forward to, a little bit of a 20% deduction on their income. It's great. It brought you down from having a top tax bracket of 37% down to a little under 30%. Unfortunately, unlike the 21% C Corp rule that's permanent, this one is going to go away in 2026 currently. It could be extended, but like we said, we don't have a crystal ball. We don't know. But I think that'd be a little harsh. They would hopefully do something for business owners going forward, but just a heads up, this is just that 20% deduction. Now, there are certain fields that it's like CPAs.
Those SSTBs.
The SSTB, specified service trade or business. You are limited on how to calculate this deduction. but I mean, unless you're an engineer and you have great lobbyists, but not everybody gets this. So just, there are income limitations. Just be aware that, this is a great thing. Your CPA should know about it.
But
And
it's set to go away. And that's a little unfortunate because I know some of you guys have this QBI loss carryover where you have to,
yeah, for
so
sure.
Not the greatest news, but
Yep. Okay, free money. Here we go. Let's get into it. Everybody loves free money. This is amazing. So this is employee retention credit. I'm going to go ahead and talk about the history and misconceptions about this, how you qualify for the credit, what you need to know and look out for, and is it really free? I mean, is there anything? I mean, not everything is free.
what's the catch, Yolanda?
What's the catch? We're going to talk about it. So let's go. All right. So the way this came about is the ERC was developed because, during the CARES Act, it was COVID. Congress wanted to incentivize employees to keep employers to keep their employees paid. Basically, this is a payroll tax, not an income tax, a payroll tax. So they came up with some things. So this is what it is. So you have to pay your employees between the time of March 15th and December 31st of 2020. So there's qualifications that you have to have. There's two major ones. One is you have to have had a 50% or more reduction in your gross receipts as compared to that same quarter in 2019, or you have to have been a part of the full or partial shutdown of operations due to a government order, federal or state. Okay. Now, if you qualify for those two things, you can get up to a 50% of qualified wages, which is $10,000 per employee for the year. So the max credit is $5,000 per employee for the year. Now, once you get through, you can go to the next slide. Once you get through and you decide, okay, yes, I had a 50% drop in revenue for a quarter, or no, yeah, I was shut down. They told me I couldn't do it. Okay, great. You qualify for that first step. Let's go to the second one. Do you have 100 or fewer average full-time employees in 2019? Yes. Perfect. You are good. You can get this credit. How about I had 102. I had 102. I have too many. Well, did you pay them? Were you an amazing employer? And you said, you don't have to come into work and I'm still going to pay your paycheck. Yes, you now qualify. You are a large employer if you had over 100 full-time employees, but if you paid your employees not to work, not work from home.
I was curious about that.
Not work from home. They're still working if they're working from home, hopefully. But if they are not working and you pay them, you qualify for this credit. Now, here's the thing. I've had so many clients come and say, hey, do I qualify for the ERC in 2020? This is the question. And our question was, did you get the PPP loan? Well, yeah, no. The answer is no. Quick and easy. No, you don't qualify. So a lot of people were turned away. So just know this initial credit in 2020, no, if you got PPP loan, no credit. Okay, so Congress basically was like, no one's getting this ERC credit. We have all this money to give away. We want to help people. And, it's the CARES Act wasn't exactly what we intended. So here comes the Consolidated Appropriations Act of 2021. This had some major changes. Some of it was retroactive. Some of it is as of 1/1/21. So that's good to know. So what they did was they extended it 6 months. So now it's all the way through June 30th, 2021. So great, perfect. They also increased the amount of wages. So it's 70% up from 50% of the first $10,000 of qualified wages per employee per quarter, not annual, per quarter. So that's a max credit of $7,000 per employee per quarter. So you can potentially get $21,000 for an employee in 2021 for all 3 quarters. So the gross receipts test, so instead of being 50% decline, now it's only 20. That's a plus. A lot of people were down 20%. So that just made it easier to get. And you can also look at the preceding quarter. You can see if you're even qualified. So what that means is, let's say 2020, quarter 4, an employer was reduced compared to 2019 quarter four, they were down 34%. They were down in 2020. Well, unfortunately, they don't qualify for the credit in 2020 because they're less than 50%. Well, quarter one, 2021, well, compared to quarter one, 2019, they're down 14%. Well, crap. I mean,
Still don't qualify.
still don't qualify. You're in a 20%. But you can look back at the prior quarter, which is quarter four, 2020, which was 34, which is over 20. And now you are qualified for that quarter one, 2021, based off of your prior quarter's credit or percentage. And just know it, just because you don't qualify in one quarter, look at the one right before it. If you do qualify, you can use that quarter to calculate your credits. Okay, so large employer was updated to include 500 full-time employees. So we're up. Bigger companies can now start getting, taking advantage of this. Same thing, if you had more than 500 full-time employees, if you paid your employees to stay home and not work, you can qualify. Also, retroactively, if you got a PPP loan, you are now eligible to get that ERC credit, which is win-win for sure. Something to note though, you cannot use the same wages that you use to calculate your PPP loan forgiveness for the ERC. You can't double dip. Nobody, the IRS doesn't like double dipping. So what happened was, a lot of people, when you calculated your PPP loan forgiveness, you can use your utilities, your rent, your payroll wages. There's a lot of expenses that you can use to prove to the IRS that you can get the PPP or the SBA, the PPP loan forgiven. But a lot of people are like, I got a 500,000 credit. I'm just going to use wages. I have enough wages to cover that. No problem. So they put it all the wages. Well, guess what? That just limited the amount of ERC that you can get. So just be cognizant when you go to apply for this credit, the person that's doing the calculation is going to ask you for that PPP loan forgiveness because they want to see how you calculated it. They want to see what wages you used because you can't use those. Same thing for R&D credits and all the other credits. If you use specific amounts of wages, you can't use those same expenses for the calculation. So it gets real complicated real fast. And I highly recommend you talk to somebody who knows what they're doing when you get this calculated. So along came the American Rescue Plan Act of 2021. They're still improving this stuff. They're still changing it up. It seems like every time they pass an act, they throw something else in here because they're trying to get more and more people to use this. So the ERC was now extended through December 31st, 2021. Great. We got it for the rest of the year. High five. Beautiful. They also added recovery startup businesses because all the people that started, well, I wasn't in business in 2019, or, I started after or during COVID. They didn't qualify. They had nothing to compare to. Well, now they're saying if you were a recovery startup business, you began after February 15, 2020, you average $1 million or less in gross receipts, you can get for the last 2 quarters in 2021, a credit of up to $50,000 a quarter or $100,000 for the year. They also added severely financially distressed employers. So that's anyone who had a more than 80% drop in revenue over 2019, you qualify. And if like one quarter you were 80% down and the next quarter you were only 5%, well, you still qualify because you were 80% down that initial quarter. So you get 2 quarters that you can, qualify. Now, what this act also brings was the statute of limitation on assessments audits. They changed it. They increased it from 3 years to 5 years. Now they have more time to loot you, come after you. So just know that increase, you only have, you need to make sure you have all your ducks in a row because they will be looking at these and they have more time to do it. Next. So the last update, well, the most recent update, the Infrastructure Investments and Job Act. What they did was they said, no, we're going to push that deadline back. Most businesses, you have until September 30th, 2021. So only 3 quarters in 2021. But if you're a recovery startup business, we're going to let you keep it till December. So those are the only companies that are able to take it for the full year or for the end of the year is the recovery startup businesses. So what you need to know and what you need to look out for. Let's talk about that. All right. What is qualified wages? W-2 employees, 1099 employees do not qualify. You have to pay payroll taxes, W-2 employees. Unfortunately, no family employees. So if you have a family-run business and everybody that works for you is related to you, unfortunately, you don't qualify. Or if you have a handful of employees that are family, but you have a bunch of related employees, well, you can't look at the people that are your blood. So just know that family doesn't count. You must have had either a decline in gross receipts as compared to 2019, experienced a government shutdown, and there are talks about supply chain issues resulting from COVID-19. I'm going to get a little bit more into that because there's a lot of controversy around that. Also, of course, no double dipping on expenses. Don't do it. Supply chain qualifying factor. Okay, everybody knows there's an issue with supply chains. I mean, cars are taking forever to come, like just it's taking longer to get your stuff. So in order to qualify for the supply chain issue, you have to have had your operations fully or partially suspended due to a federal government mandated shutdown. This has to be COVID-19 related. So your inability to get goods and materials from your suppliers due to the government shutting you down or shutting them down is how you qualify for this. It's really tricky. It's really hard to do. Let's talk about what are non-qualifying. Next slide, please. There you go. Okay, so you have a supplier. They, due to COVID, they decided to reduce hours of the employees. They decided to self-limit production, all on their own. They weren't mandated to do it. They did it all on their own. That does not make you qualify for this. If your suppliers are having trouble giving you your stuff that you need, because they can't find employees or, they don't have employees, that is also not qualifying. That's not okay. So your supplier's inability to produce or deliver materials due to something other than COVID-19. We all know the Texas freeze, that shut down so much stuff. I mean, that we're still recovering from that. So anything outside of COVID-19, you do not qualify for this. So there are a lot of companies out there trying to get people to say, oh, all you got to do is a test. You have to test the supply chain issues. The IRS isn't going to ask you anything. You just need to sign a paper and saying that was me. No, do not do that. Because when you're audited and they ask you, show me proof, but I tested to it. Well, that's fine and dandy, but don't do it. You don't want to be in that predicament because they will cancel you in a heartbeat. So just be cognizant of these supply chain issues. How do you get the credit? Okay, first of all, you decide which quarters you qualify for, and you do so by talking to somebody and having them help you calculate it because it is
Involved.
It is involved, yes. So, but once you do figure out that you qualify for it, you're going to amend your payroll tax form to 941. They used to have you file a form 7200. I don't think you have to do that anymore, but you're going to amend your payroll tax returns. So in doing so, remember that no double dipping. Well, the IRS says you can't take expenses on your tax return that are equal to that credit. So if you got a $500,000, well, let's be realistic. You got $150,000 ERC credit, you're going to need to reduce your wages on your business returns by $150,000, which means for those partnerships and S corps, you're going to have to amend those personal returns as well. So, there is some cost to amending. So just know that, but it's going to have to happen. And you have, good thing you have 3 years to amend. So 3 years from the date that you filed your return. So your 2021 return was due July 20, well, your 2020 return was due July 2021 or October 2021. So it just depends on when you filed it. So it's 3 years from the time that you filed your return is your date that you have to amend. So just make sure you get that done. Is it really free money? I mean, isn't it anything ever free? I mean, it sort of is. I mean, the government is legitimately going to send you a check. You will get a check in the mail for that credit amount. Now, because they're short staffed and it's the IRS, it's taking currently like 6 to 8 months to get that money. It's going to come. It's just going to take a while. And you have to offset your wage expense for the amount of your credit before you need to amend your returns, which is going to cost you money. It's going to cost you money to get money, right? You have to pay money to get money. Something to note about that is it's kind of like, do you recommend amending now or amending later? Like, do you wait till you get your check in the mail because of that expense? You're going to have increased, well, potentially federal income tax on this increased income that you're going to have from the amended returns, and you're going to have to pay for those returns. Do you wait for the ERC credit to make sure that the IRS doesn't change your credit amount and decrease it? I mean, it's up to the taxpayer. The taxpayer needs to make that decision with the CPA. You need to talk to them. I mean, you can amend it as soon as you file for the credit, but know that if the IRS changes it, you're gonna have to amend it again. So talk to your CPA, get their advice on the timing, and just make an educated decision. And a word of caution, be careful who you have help you calculate this credit. There are a lot of companies out there that are fly-by-night ERC companies, and they're going to charge you a pretty penny to do this. And they're going to promise you the world, but guess what? Are they going to be there in 2 to 3 years when you're audited? So you want a company that's going to be around, that knows what they're doing, that can back you up and you know, have solid calculations. Just, you know, be really smart about who you have help you with this credit to make sure you're doing this the right way. So what does this mean for you and your business?
So thank you, Yolanda. So what we tried to do is take some of these changes and updates in the law and give you guys some quick tips just to see what you can do now as your year-end planning. So as we've talked about, bonus depreciation phase out in the next 5 years is going to make it less advantageous. But 179 deductions are now up to that $1 million limit for expensing and also indexed for inflation. Is that right?
That's right.
Good to know. So that $1 million limitation is going to increase every year. So it may be more beneficial as you're looking at your fixed assets, your purchases, 179 versus bonus. Another really cool point about it is you see this 80% NOL limitation. If you take a 179 deduction and you're in a loss situation and the 179s carry forward, that carries forward at 100% versus if you take bonus on something, create a loss, now you've got an NOL that you can only take 80%. So really now, based on our research, we really think 179 is going to really come into play now and be much more advantageous than it has in the past. Also, looking at your fixed asset purchases, it won't be so easy to say, I purchased $1 million, I'm getting $1 million deduction. There's going to be so many more considerations because of the 179 business income limitation. I don't want to bore you with details, but it will become more essential to really calculate this rather than say, oh, I got 100% of my assets. So something to consider. And this is kind of the workaround I talked about to avoid getting trapped in that 80% NOL limitation where you just lose 20% of your losses and they just disappear. So this is a great way to kind of preserve that. We talked about this before, plan out those energy efficient improvements as the law comes into effect. Hopefully you can take a look and determine, do I need to make this improvement this year? Should I push it off to next year? Because all those categories of property subject to different limitations, it may take a little bit of calculation to see how you want to plan out those improvements. Business loss limitations are adjusted for inflation, just good news. The buying a used vehicle, I don't remember if I touched on this, but dependents, if your kid in college is getting a used electric vehicle and they want that credit, careful. Dependents, whether they're claimed or not. So if you're a parent and you give up your exemption on your dependent, doesn't matter. They still do not qualify for the credit. Something to consider. You take the title of the car, purchase the vehicle, claim the credit, transfer it to your kid, just to not lose out on that money because of who is purchasing the vehicle. For construction and home builders, be very careful where you're doing your projects. And if you're going to be claiming energy efficient credits, do make sure you are meeting those prevailing wage requirements, because if you don't meet those requirements, there is a $5,000 penalty per employee that you underpaid. if you don't do this correctly. So do make sure you're planning that out if you're expecting to take those credits for the efficient energy homes. Document. The reason we say this is, first of all, I didn't get into it, but a lot of the new law does require documentation. If you're claiming an energy vehicle credit, you'll have to provide the VIN to the IRS. Also, for energy improvements, you will, starting in 2024 or 25, you will have to provide documentation to show that your energy improvements are qualified. So now more than ever, very important to document. Also, with the IRS getting additional funding, they will be looking back at audits and assessing things, making sure that people who are claiming the credits and money now are doing it correctly. So their funding's going up. A lot of these credits require documentation. So do hold on to those records, create a fun little tax folder for yourself and hold on to those records. And then last but not least, plan a meeting with a tax professional. You know, these are not easy calculations to go through anymore. It's getting a little bit complex. And so you can't just glance at your financials and say, oh, I qualify for this credit. Let me do that. It's going to take maybe a little bit of analysis and a little bit of work, but hopefully the work that is done on the front end does save you more money, headache, all of that. You can sleep soundly knowing your credits are good. So these are the takeaways we have for you guys. Thank you so much for being with us today. And if you didn't think of anything during the presentation, we're so happy to get back to you. If you come up with a question tonight, if you
reach out,
think of something, please do reach out.
There is one question in the Q&A before I let everyone exit the webinar. So speaking of S corporations and the fact that family member wages are not eligible, the wages paid to the C corporation shareholder are also not eligible, correct?
To the C corporation?
To the owner.
S corporation.
Oh, absolutely. S, yes, absolutely. No. Owners pays not.
Has to be employees, unrelated employees.
Yes, employees.
Well, Kat, Yolanda, as I said before, we had a lot of material to cover, and I'm so thankful that we had you both on today. And if you have any questions for Kat or Yolanda or anything else about LGT, please reach out to us at askus@lgt-cpa.com. Thanks again, ladies, and I hope everyone has a great day.
Bye everyone.
Bye.